Now, for this next chart, we are actually going to look at the same data series as represented by two different charts, and this is from Calculated Risk blog. Construction spending in the United States, which tells us a lot about a housing bubble and a housing bust and the possibilities of those. This is time, 1993 to present, so 30 years. And this is spending in billions. It is not as a percentage of GDP, so a natural rise is to be expected and is desirable, but even when it's not a percentage of GDP, you can see the distortions caused by housing busts, which are themselves caused by the Federal Reserve's ultra-narrow printing policy. I have said many times that printing money just by buying treasuries and mortgage-backed securities causes distortions in narrow sectors of the economy, whereas a more diffuse form of printing, such as sending cash directly to people and rebating income tax of the same amount, would actually be fairer and more granular and not cause these types of sharp booms and busts. Because from this red line here, you see the previous housing bubble peaked in 2007, 2008, and how that crashed so completely for so many years, and how drastically that collapsed and how many years it took for that to even recover. The blue line, which is non-residential construction spending, rose even as this was falling to mitigate that bust. Otherwise, it would have been even worse. However, non-residential spending cannot always be the substitution. You are just taking out of one pocket and putting in another, and you can create oversupply in all types of real estate then. So what is happening today? We again have excessive residential real estate construction because of the nature of Federal Reserve's printing. The amount of money printing they did was not high, as I say often throughout this channel, but the style of money printing they do causes more problems that do not need to be caused. And this is already corrected. This blue line is compensating. Non-residential construction spending is compensating for that. But for how long? For that, we now look at this second chart. This second chart is the same data, but a percentage year-over-year change. So the same red, blue, and gold lines corresponding to residential, non-residential, and public government spending, but as a percentage year-over-year change. As we saw, the red line had a steep rise, more than 30% year-over-year change, and now that is negative because of that distortion, as I described. Non-residential is offsetting that and keeping the housing bust at bay, but only by creating an oversupply of a different type of real estate, because this is 20% now. And remember, when construction spending is negative, that also means fewer construction jobs and therefore negative impact on GDP, as well as on other housing demand by people who earn their living from the construction industry. So these correlations work in both directions, boom and bust, and this is what the Federal Reserve does not seem to understand because those PhD economists are hyper-theoretical. So the housing construction market is already in a recession, not as negative of a percentage as we saw in 2009 and 10, but already quite negative because this positive was already higher than was ever achieved back then. And this blue line has to stay extremely high just to keep the collective sector out of an extreme bust yet again. Long-term, the demand for single-family homes in the United States can only go down because the U.S. marriage rate has collapsed and family formation among the younger generation is much, much less than it was among the older generation who are expecting that new families will be buyers of their homes. That is not happening, because the marriage rate has collapsed in the United States for many, many different reasons. These are all factors to think about, but this chart tells us a lot about what the future may hold for the housing market and for construction as a predictor of the housing market. Thanks for watching.